How rich people avoid paying taxes to get richer. According to the United States Department of the Treasury, the wealthiest people in the United States may be evading as much as $163 billion in annual income taxes. And many of them are using tax rules to do it in an entirely legal way, according to financial experts. Even though taxes in the United States are proportional to one's income, the highly wealthy frequently find ways to minimize the amount of money that they must pay. According to research by ProPublica, many wealthy individuals, including Amazon's founder Jeff Bezos and Tesla's CEO Elon Musk, pay disproportionately low taxes on their income. The vast majority of people in the United States obtain their income from a full-time job, for which they receive a paycheck and are taxed on their earnings. But the wealthiest 1% of Americans makes the majority of their money from investments in items like real estate or the stock market. These investments generate taxable income in the form of capital gains. In contrast to the maximum rate of 37% that applies to the federal income tax, the maximum rate that applies to the taxation of capital gains is only 20%. Because of this, Warren Buffett, considered one of the wealthiest in the United States, has frequently stated that he pays a lower tax rate than his secretary. Proponents of President Biden's plan to raise that maximum tax rate see it as one method to tax wealthy individuals. And the plan calls for an increase from 20% to 39.6%. However, Buffett and other billionaires will still avoid paying taxes on the vast majority of their wealth. You can find out how the wealthiest people in the United States get around paying taxes by watching the video that is located above. The secret industry of tax evasion. Since 2014, the International Consortium of Investigative Journalists, ICIJ, has been responsible for the leak of many documents, including the Panama Papers scandal and the Paradise Papers scandal, which reveal how tax evasion and avoidance have become the standard business practices across the globe. Among these scandals are the Panama Papers and the Paradise Papers. Multinational corporations and wealthy individuals deliberately strive to grow their earnings by keeping them offshore and evading paying taxes in their respective nations by taking advantage of a tax system that is both complex and laxly enforced. Havens from taxation are an essential component of this system. They make it possible for large quantities of wealth to be transferred without paying taxes and in complete secrecy, beyond the reach of tax authorities and regulatory agencies. The winners: big corporations and super rich people. Those at the very top, including wealthy individuals and multinational corporations who can leverage their position and influence to appropriate economic gain for themselves and manipulate economic systems to their advantage, are the primary beneficiaries of this system. Those who should be paying the most significant amount of tax maximize their profits by paying the least legally possible tax. They accomplish this goal by utilizing tax havens or by creating a competitive environment in which nations offer a variety of tax advantages, exemptions, and reduced rates. And although some of the methods of evading taxes are against the law, many others use loopholes in the current system without breaking any laws. In the top 200 companies in the world, 9 out of 10 have a presence in tax havens, and the amount of money invested by corporations in tax havens has increased fourfold between 2001 and 2014. The 50 largest firms in the United States hid away $1.6 trillion offshore in 2015, while Europe's 20 largest banks are registering more than a quarter of their profits in tax havens, which is anticipated to amount to $25 billion for the year 2015. According to the revelations made by the Panama Papers and the Paradise Papers, a significant number of affluent people from all over the world, including well-known celebrities and influential politicians, are using tax havens to avoid or evade paying taxes on their assets. The losers: ordinary people in developing countries. When wealthy individuals or multinational organizations store their wealth in tax havens, they can avoid paying taxes in the nations where they conduct business and make the majority of their profits. They deprive governments of the resources they require to deliver essential public services and infrastructure, such as schools, hospitals, and roads, as well as to combat poverty and inequality due to their actions. Either the government will need to reduce its spending on these types of services, or it will need to raise taxes to make a difference. In any scenario, the most disadvantaged members of society will be disadvantaged, and the gap between rich and poor will widen. This worldwide system of evading taxes is sapping the vitality of welfare governments in wealthy countries of the world, but the impact is considerably more catastrophic on countries with lower per capita income. At a minimum of $100 billion each year, developing countries lose revenue due to tax evasion by corporations. This money is sufficient to ensure that 124 million children receive an education and avert the deaths of roughly 8 million mothers, infants, and children per year. Just for Africa, the use of tax havens by the ultra-wealthy result in a loss of $14 billion in tax income. This amount of money is sufficient to pay for medical care that could save the lives of 4 million children and pay for the salaries of enough teachers to ensure that every child in Africa receives an education. Sharif Muhammad, founder and CEO of Unlimited Financial Services in Somerset, New Jersey, and a certified financial planner, as long as you follow the law, everything is fair game. More from Personal Finance. According to calculations provided by the Treasury Department, the capital gains tax proposed by House Democrats is preferable for the ultra-wealthy compared to Vice President Joe Biden's plan. Under the plan proposed by House Democrats, taxes on millionaires would go up by 11% in 2023. Capital income refers to earnings made from investments such as interest, dividends, capital gains, or rent. Most Americans earn money through labor-based means such as salaries and benefits. However, those who are incredibly wealthy may receive income from investments in the form of capital income. Most middle-class and working-class Americans pay taxes through withholdings from their paychecks. However, the wealthiest 1% of Americans may not report any income on their tax returns because they can delay selling investments or use losses to offset capital gains. For instance, Mohammed explained that an executive might earn stock-based remuneration. When it comes time to sell, they might sell other investments losing money in the same year to cancel out any taxable growth they've seen. When the wealthy need cash, they can borrow money against their portfolio through asset-based lending, eliminating the need to sell appreciated investments that may result in gains. This is a common strategy that is becoming increasingly popular. In addition, the portfolio loan does not need to be declared on a tax return because it is not taxable. That is probably one of the most prominent ways they can keep that income off the purview of the IRS, Mohammed said. They can do that in many different ways. The wealthy sometimes keep their possessions until death, passing them on to their heirs to avoid paying capital gains taxes. A step-up in basis means that the value of an inherited property is generally adjusted to what it was worth on the date of the deceased person's death. President Joe Biden has advocated for taxing gains at death, with an exemption for growth that is less than $1 million for single filers and $2.5 million for married couples. Nevertheless, the item was removed from the Democrats' $3.5 trillion spending package a week ago by House Democrats. Wealth transfer taxes. According to Lisa Feathergill, certified financial planner and National Director of Wealth at Comerica Wealth Management in Winston-Salem, North Carolina, it's not all about income taxes for the ultra-wealthy, said Lisa Feathergill. It's also about estate and gift taxes. The tax on the transfer of wealth is of equal significance. A person who leaves wealth to their heirs or gives assets during their lifetime may be subject to federal estate or gift taxes of up to 40% for properties with a value of more than $11.7 million for individuals and $23.4 million for married couples, as a result of the tax overhaul that was enacted in 2017 under the administration of former President Donald Trump. Although these levels will shrink to about $6 million and $12 million after 2025, Democrats in the House want to reduce the exemption to $5 million so that they can pay for their spending plan. Only some things have to do with income tax for highly affluent people. The tax on the transfer of wealth is of equal significance. According to Feathergill, in the interim, wealthy families are making donations to lower the number of their estates that will be subject to taxation before the 2026 deadline. They also use estate planning tactics such as so-called dynasty trusts, which enable families to pass money from generation to generation without facing estate taxes at each death. To assist paying their spending plan, the Democrats in the House have proposed restricting several of these widely used strategies. Those who are generous may also give to charity organizations, which enable the contributors to receive a tax write-off at the federal level if they itemize their deductions. Donation to a fund known as a donor-advised fund, which is made by wealthy families and benefits charities with time, can be made. According to Fethergill, those who make more extraordinary gifts and desire more control over the organization's direction may establish a private foundation. Illegal. Michael Bloomberg, a former mayor of New York whose tax details were among the records, reportedly stated that the publication raised privacy concerns and that he would seek legal means to find the source of the leak, and added that his tax information was among the documents that were leaked. An investigative website known as ProPublica has published multiple pieces on how budget cuts at the Internal Revenue Service of the United States have hindered the agency's capacity to enforce tax rules on wealthy individuals and large organizations. According to the news organization, it obtained the records released in reaction to the publications. The press secretary for the White House, Jen Psaki, stated it's against the law to disclose private government material without proper authorization. In an email statement sent to Reuters, a spokeswoman for the Treasury Department named Lily Adams claimed that the subject had been reported to the FBI, federal prosecutors, and 2 internal watchdogs inside the Treasury Department, all of whom have independent authority to investigate. Commissioner of the United States Internal Revenue Service, Charles Rettig, stated, "Regarding particular taxpayers, I am unable to comment on anything at this time. Regarding the claims that the Internal Revenue Service was the origin of the information contained in that article, I can attest that an inquiry is currently being conducted into these allegations." So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.